Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Hi, this is James with Full Capital, and appreciate everyone jumping on. We have a great show coming up for you with Jeff Adler from Yardi. So here's sort of the lay of the land for this particular speaker series. We'll just do a quick intro on Old Capital. We'll go through just sort of some of the questions we've got recently on sort of the lending side, and then we'll have Jeff sort of run through his slides, and then we'll have networking for people who want to hang out after the presentation. So if you're not familiar with Old Capital has been around for a long time, probably 25, 30 years. Here's a snapshot of the team. About half of us are here in Dallas, half in California, but we lend nationwide. We are a mortgage broker, so we do pretty much everything. Here's some recent deals that we closed in 2024. Most of it Fannie Freddie, some HUD stuff, some construction loans, some Freddie SBL, some smaller deals as well. So I think most people, they start with us. We're doing, their 64 unit deal, and then we move up, end up doing, their 280 unit deal. So if you have not seen or heard us on various, different segments, I would say our podcast is probably number one of where most people have heard of us. So if you have not subscribed to the podcast, definitely check the podcast out. We put a bunch of stuff on YouTube, and then Julie hosts a Zoom at 8. I think she had one last night on Tuesday nights. So if you are not in Dallas, that's probably the best way to see us on a weekly basis almost. But if you are in Dallas, or if you want to come to Dallas, our next bus trip where we take people and see some of these properties live and in person is May 16th. So you can go on Old Capital Podcast has a link, and then also if you join our email list, we have a link to that trip. But we just did the one in March, and we had about 45, 50 people on the bus going to look at some of these properties. And then our big conference is October 8th and 9th. That one we'll have probably 300 or 400 people at, and that's our largest event of the year. So if you're going to come to Dallas one time, that would be it. So if you can make that, that'd be great. But here's sort of a snapshot of what I'm seeing right now. I made this chart a couple days ago, so it's moved around a little bit. But, we are still seeing bank loans sort of prime plus or minus 50. So, close to 7.5. Freddie Mac SBL, they've changed their rates as fast as they can update them. So every time 10-year Treasury moves, so we're seeing probably 6.5 right now. Fannie and Freddie, if you hit exactly where 10-year dropped last Thursday and Friday, you probably could have been low fives. But we're seeing higher, sort of mid to high fives right now. Non-recourse bridge, we are seeing pretty tight spreads. So SOFR plus 250 to 300 on sort of your A stuff. On the B and C stuff, probably closer SOFR plus 350, just depending on the size of the deal. I did want to pull in a couple questions that we did have on financing that users had submitted. So, this is probably the number one question that we keep getting is, will banks continue to extend these troubled loans or start sending them to foreclosure? So we're starting to see more foreclosures, but then we're also seeing tighter terms on extensions. So what that means is not only do you have to do the extension fee, not only do you have to do the interest rate cap, but you're going to need to do a pay down on the deal to sort of right size the deal. And so we're seeing, especially a couple bridge lenders, just sort of force your hand to where these deals are now going to sell. And so we're seeing a lot more deals on the market than we did, let's say, Q1 of 24. People have asked us about the privatization of Freddie and Fannie. I don't think anyone knows the answer on this one, but, we talked to some of our Fannie reps today, and a lot of them, as long as the government guarantee is still there, I think they feel comfortable that, this will not materially impact the interest rates, and they will sort of go on as business as usual, but they see this as a couple years out still. And then the last one, people have asking us about fixed or floating rate debt. We got a lot of questions on this. Majority of deals that we're seeing right now are still going fixed rate. but they are going shorter in term. So they're going 5-year, 7-year money, even with the yield maintenance. The variable rate stuff is really on the bridge loans out there. So on some of these deals where we're seeing trouble, they are going to the existing lender and saying, "Can you cut us a deal?" And a lot of those have variable rates, and people are buying, and the money strikes on those. So we had, 200, 250 people register for this, and I feel like I got this question 60 times. Are these couple questions like 50 or 60 times? So I wanted to touch on those for people who had put in their questions. And Jeff, we'll sort of take it organically, and as you go through your presentation, we will go through questions that come up. So put your questions in the chat as they come up, and I made you a co-host. So if you want to go ahead and try to share your screen,
Yeah,
I'll stop
super.
sharing and then we'll go from there.
All right, let's see how this rolls.
See
Okay.
if it works. Yeah.
Okay. Let me also do the slideshow deal. There we go. How's that looking?
You're good.
Outstanding. Okay, so boy, have we got a lot to cover. So we're going to cover a section on the economy and what's actually happening in the world. So I put a few slides in here. I don't really want to use all the time, but I do think there's so much else out there that we kind of have to address it. And also we'll also talk about public policy. I will talk about fundamentals, something that are going on in affordable housing and how affordable housing interacts with market rate housing, some data on income and expenses, and then some sort of investable themes or investment themes like work from home and the movement of people, migration, and reindustrialization, and sort of what's going on with that. So that's really where I want to kind of take this. Okay. So here we kind of go. Up until, through the first quarter of 2025, okay, you were looking at kind of 2-ish% growth. Okay, that is now kind of thrown up in the air, and I'll talk to that. We had the Fed, seeing inflation kind of coming into the strike zone, lower interest rates a little bit, but now it's kind of stopped. Inflation was always sticky-ish between 2.5 and 3. We saw that the last numbers are 2.8, really due to globalization. Okay. And we needed to see something change, a big decline in energy prices, a big decline in something that would then result in an increase in short-term rates. Okay. We're not really seeing that. Okay. And so now I kind of want to talk to that. There is even though the economy up and through the first quarter looked like, yeah, everything looks kind of okay, there were absolutely problems brewing in terms of lower income consumers under stress and job formation kind of stalling out, except for low value added types of occupation, government, healthcare, and hospitality. Okay. So problems in there. So the labor market is tight due to long-term demographic reasons, and that's not going to go anywhere. We had a pop in illegal immigration. That policy now being decided, a new policy mix is emerging. Okay, so where you've got deflationary components in deregulation, lower energy costs. Remember, oil prices this morning were at $58 a barrel. I think it ended up at 62, way down from 77 at the beginning of January. So those are the disinflationary components of the policy mix. And then immigration and trade policy being the potential short to medium term inflationary components. So it's very important to understand that this is a policy mix issue. Okay. Now, I think the economy looks more like a 1%. The 2% was an old version. I've been updating it like 4 times over the last couple of days. We still have very large fiscal deficits, 1.6 trillion, which have been counteracting the ability of monetary policy to be restrictive. Okay. And that's why you haven't really seen the supposed increase in interest rates really hasn't flowed all the way through. Okay. Overall, the multifamily market, again, I'll kind of, it's sort of like, April 2nd before, April 2nd after. Okay. The market's been performing well. So you have 20 markets where there's been a lot of supply delivering off of as a result of the downslope of the big run up in demand and rents in 21 and 22. Again, and so you're now on the downslope of that. Okay. So national rent increases have been modest. You take those 20 markets out, rents are growing 3 to 5%. Okay. With those markets, it's in the 1% kind of range, but those units are getting absorbed. All right. And that's kind of the good news. All right. From a fundamental standpoint. Also, because of the run-up in expenses and the run-up in capital costs, starts have been declining, and there's going to be a delivery decline from, 24 was the peak, 25 will still be high, but coming down, 26 and 27 will continue to decline. So you're building the next wave of the next cycle in 27. Okay, so that, again, we're a cyclical business. You can see the next cycle building, all right? We have a structural housing shortage in the United States. This is not going to change. It's once this supply wave is completed, it is mitigated in certain places that are business friendly, but we still have this basic issue which has not been resolved. And I would say distress in multifamily is sort of showing up. I think, James, you said it well. We are seeing an increase in, again, through the first quarter, about a 50% increase in volume of sales transactions relative to this time last year. So stuff is beginning to trade, and I would probably say that indeed things are being forced to loosen up. But remember, the banks and all the other sort of folks they've been taking their reserves on office, and that's where the hits are going to be. That's where they're expecting the hits to be. Okay, let's kind of move on then. The important thing here is there's some big major changes, okay, that are happening here. The geopolitical and economic deglobalization is like number one. So that's where we're seeing that in the headlines now. Nearshoring was already happening. U.S. reindustrialization was already happening. Sticky inflation was already happening. They've basically been turbocharged over the last week. We've got a demographic aging population with declining birth rates. And even with sort of the surge in illegal immigration, we really don't have a big increase in population, and population growth is declining. And we've got some charts on when that tops out, kind of in 2040. Okay, so you've got some population growth, but by 2040, it kind of levels out. And then it's being in places, in cities that are amenable and business friendly. Okay. The COVID aftershocks are really, it's the spreading of the U.S. population, hybrid work being a permanent function for most of American workers, and a higher government debt to GDP ratio that kind of has to be kind of bent. The housing shortage is not going away. Okay, so there's, and if you see this in 24 and 25, a lot of supply, but only in 20-ish markets. All right. Again, most of the country has not had a lot of supply, and rents went up in COVID and are still growing. Okay. And I've gone back to look at these, high supply markets, big tech hub markets, Texas being many of those, back to 1970. These economies continue to grow, continue to expand. They're great places. They're very business friendly. This cycle happens to have been a big cycle, a big run up in rents and a big supply response. So it's just a big cycle, but very typical. And I would tell you, political polarization is a very big deal. How a local society within the state, within a city, responds to the shortage. Do they focus on creating supply, what I would call enabling abundance, or are they so focused on allocating shortage that they end up doing counterproductive things? And we're seeing a lot of that throughout the United States. Okay. Now, when I talk about the presumed policy mix of the Trump administration, right? Again, energy production, low energy prices, high levels of domestic production, if at all possible, to reduce inflation and to basically push exports to Europe to generate sales, revenues, capital, okay? Both to Europe and to allied Asia, particularly Japan. Government deregulation, which acts as a back-ended tax cut. You're seeing this in terms of government staff reduction, department closures, which has a temporary reallocation of labor, and also basically cutting a lot of expenditures so that there isn't as much of a need to float debt. And basically the easy stuff's being taken on first. And you can see how hard the easy stuff is to actually get done. But this, what Elon is working on, is the easy stuff. There's much, much harder things to do, like entitlements that won't happen for several years. Now, on the other, and lower taxes, retaining the 27 taxes and other tax reductions. Now, the other part of that is trade and China policy. And I really want you guys to think about the tariffs are actually a reordering of an 80-year sort of infrastructure of global trade and monetary policy that's being rewritten, because that process started for a few countries in Western Europe after the Second World War and kept getting extended and extended and overextended. And the final overextension was the WTO, letting China in the WTO 25 years ago. So what Trump is doing, and you saw it today, was he's reordering relations with Europe, which never got reoriented in the 70s. He's reorienting relations with the rest of the non-developed world, which was basically incorporated into the U.S. global system in the 90s. And he's reordering relationships with China. The first two is just changing the terms of the deal. The last one with China is locking them out and basically pulling a Reagan. When Reagan squeezed the Russians hard and forced them to collapse, that is precisely what Trump is doing. He knows the Chinese are vulnerable, and he's going to squeeze them until they break. This is a very high-risk, dangerous set of situations that we're dealing with, but it is completely understandable and needed to be done at some point. It's just getting done all in a hurry, all right now. Government spending is still high. We're not going to touch entitlements for several years, if at all. I do think we'll get to them in the back end of the administration. But right now, you're taking out the easy stuff, the fluff. Also, defunding the left from all the USAID, all the universities. Is all about defunding parts of the society that basically never had to come to terms with living within their means. So all that's kind of laying out. The housing policy is really a second or even third order consideration of the administration. Federal rent control is off the table, but the problem is shifting to the states and localities. That's even getting worse. Again, there's some GSE stuff going on, light tech, but honestly, housing really is third tier level of concern. Okay, now what I've done here is given you the net. I'm going to go through the pieces of where I think growth is and inflation and unemployment and, a guess on bond yields. But, James is probably better at this than I am on that. What I could say is we do expect to see, it went from 2% to 1.5% to 1%. We're basically talking about there's going to be an adjustment. Even if you're at 10% tariff, there's dislocation and adjustment going on. I don't think we go into a recession, but we're going to go through a dislocation. When I look at inflation, I'm looking at the GDP deflator. There's two other measures. There's the PCE, personal consumption expenditure. The Fed looks at that, particularly core PCE. There's also CPI, which you tend to see, that the news. And there's a range. The GDP deflator is the lowest, the CPI is the highest, and the PCE is kind of right there in the middle. But bottom line, this number was, I'll call it 2.2-ish in 2024. So I do see an uptick and then a cresting. All right, where I do also see a potentially impact of unemployment going up a tad. Again, you've got government workers. They got to get recycled. Their skills and what they have to do is going to take some time to kind of noodle through. And again, you see that. And then the bond yield is who the hell knows? Honestly, is it 4? It's 4.5. There's a lot in play here. But if growth slows, one might anticipate yields going down a tad before they kind of pop up again. But I do think they're rather durable in this kind of 4.5 kind of range bound thing. Getting down to 3.5, which is where we all would love to be, is going to take time, and certainly going to take more time than in this forecast window. Yes. I'm
going to jump in. So I'm looking at all these. These are hard. Obviously, forecasts are hard to defend.
They're hard to defend, right?
But the unemployment, do you think, what's the thought process? Like, I've just seen forecasts that have it a lot higher on the unemployment towards the end of this year.
I think the issue you've got is you've got folks who are going to be paid under some sort of severance package. They're going to kind of roll. Yeah. It's going to just take some time. And there's a lot of Sturm and Drang and, oh my God, the sky is falling. The sky's not falling. Okay. The federal workers, maybe you've got 400,000 workers. 400,000 workers, I don't know, 150 million people working. It's going to be very noisy, but the reality is it's not as bad as the headlines want to make out. Okay? Remember, the headlines represent people who have a vested interest in a large government. And basically what the administration doing is ripping the money out of their hands, and they don't like it. They do not like it, and they're going to make a whole lot of noise. But it's, a whole lot of noise without a meaningful amount of substance. Okay. All right. Now, behind this summary view is basically you got to think about, I'll call it a baseline. This is what the baseline I had going into the quarter in terms of like, hey, yeah, things don't look so, things are sort of just kind of cranking along. Okay. And then you have, there's a shock due to tariffs. Okay. And then there's a policy benefit with oil price reductions, deregulation, a tax bill that comes in mid-year. And so you really have to kind of net through this, okay, to kind of say, yeah, there's probably a little bit of a slowdown, and then I have an acceleration of growth coming into 2026, right, as some of these things kind of get sorted through. So one, the world's not coming to an end. The administration isn't crazy and stupid. There is a fine level of drama. You just have to deal with the volatility associated with this. We've seen massive swings in the equity markets. Settle in. This is going to get bumpy, but I don't think it's a disaster. And so I would counsel is keep a clear head, understand the administration, our negotiators. Actually, all of this is laid out. If you look at Stephen Moran's, Miran, he's the chairman of the Council of Economic Advisors. He wrote a 41-page paper entirely laying out this playbook. Phase one is mass chaos. Phase two is renegotiate the alliances. Phase three is reorder the monetary system. It's just the way it's going to be. It actually, again, he actually had a statement last week. He had a 41-page paper over the last couple of months. It's all going to plan. You just have to settle in and buckle up for the ride.
So he's on Trump's team, the Stephen?
He is the chairman of the Council of Economic Advisors. Okay. He's a fairly influential guy. He actually was a chief investment officer of a hedge fund. So like these guys aren't dumb. Okay. They've thought very deeply about the critique of the global economic system. You may agree, you may disagree, but there is a logic and a structure to what they're trying to accomplish. Okay. And so I try to make sure I understand how people are thinking and why they're thinking the way they're thinking and how this all plays out. None of this, while it is disruptive, Trump has been talking about this for 40 years. There is nothing new that he hasn't said and why he said it. So again, we have a lot of material to cover. I'm happy to, if you want to spend the whole time on doing this, it's your time. I can do whatever you want me to do. You tell me, or otherwise I'll move on to other things to talk about.
The only question I have on here is if the tariffs stick, is the assumption that GDP goes negative in the second quarter?
No.
Okay.
No.
That's just the impact. That's just
there's
the impact.
There's an impact, and then there's another. Maybe there's countervailing impacts, right?
Okay.
Just like if you were managing a portfolio, right. There's some things that you're going to take a hit on for long-term benefit, and there's some things you're going to do in order to cushion that blow, or you're going to get returns somewhere and take hits somewhere else. This is a portfolio and a policy mix. So you can't get wrapped up in the people who are only looking at one piece of the pie. You got to look at the whole thing. Okay, you got to look at the whole chessboard, or remember, the administration is playing 4D chess. It's not just on one level. There's four things that are going on here, all simultaneously. Okay, the reduction in oil prices is the day that Trump announced his tariff increase, OPEC announced a major increase in production. I wonder if that was coincidental. Come on, guys. Embrace reality. There's nothing coincidental about any of this. Nothing. Okay, the tariffs that went off today, everything but China. You want to get people to the table, you got to make sure there's a credible threat that you're going to do something meaningful. The 10% didn't go away. Everything else did for now, which also, again, freedom of movement, lots of opportunity to snap things back by country, right? It was shock therapy, force people to come to the table, a credible threat, willing to endure pain, and okay, we'll talk about it. But China, we're going to screw you guys 7 ways till Sunday. The Chinese are extremely vulnerable. They import everything and they got to export everything. The Europeans are basically screwed. They're stuck between Americans and Chinese. They have to make some serious decisions about their future, and they are not prepared for it. They're getting hit on both sides. Their export markets are gone. The German export markets are gone. And the Americans that were subsidizing their lifestyle are basically said, we ain't doing it anymore. They have some very, very difficult decisions to make.
So maybe I just saw this somewhere else. And for people who had questions, put it in the chat. But what's your thoughts on why treasuries ran today? And if you have no thoughts, no problem. But treasuries ran 15 to 20 today. And then the thought was we're going to put it in the German bond versus the U.S. Treasury. You might have more insight into it.
I'm gonna pull up I'm just gonna pull up all the debt markets, the major bond indices. Let me just pull that up for a second, right? So if you look at this, the U.S. 10-year was 4.35. The German was basically 2.6. Right? Japan was up 1.3, and the gilt, the 10-year is 4.8. They all moved.
Yeah.
Okay. All that is like posturing. Okay. There's a lot of dislocation going on, and people can't decide should they rush into treasuries. That was the initial response when you saw it go down to 4.
Yeah,
right.
Thursday and Friday.
3.9, right? Yeah. And then you have to say, well, maybe I shouldn't put it in. Maybe I should. I don't know. Maybe it's not safe. So remember, the core issue is our debt to GDP ratio is still high. And if you look at the CBO announcement, they're saying it's going to 156%. That's not tenable. Okay. That is not tenable. So something has to change to bend the curve of the debt to GDP ratio. It's been sticking out there for a long time. We've gone through the GFC where the debt burden blew up. We went through COVID where the debt burden blew up, and we haven't stopped. So the debt's been piling up. Obviously, debt service is equal to defense spending. This is not a sustainable trajectory. It's not. But remember, you can't really fix it, okay, until you actually handle U.S. entitlements, which are demographically not sustainable. But nobody wants to talk about it. And it'll be kicked the can down the road a little bit longer, but it eventually will have to get dealt with. And I know exactly how it's going to get dealt with if you want to know. But we don't have to talk about it now. It will get dealt with. It will. And I've known it for now. I've been out of college since 84. I knew what was going to happen in 1984. I've known it all along. We've all known it all along.
Go ahead with what's going to happen.
You want to hear it?
Of course. With that lead up.
Okay, the fact of the matter is eventually, Social Security will have to be means tested. There's no way around it. Okay?
As in people who need it will get it, but people who don't, you don't.
Exactly. Exactly. It will become means tested. There's 77 cents. If you cut benefits 23%, you will get there. Okay, who's going to take that 23% cut? It's not going to be across the board. It's going to get means tested. I knew that in 1984. Lawrence Kotlikoff, who was my professor in Social Security, and he said very clearly, it's not sustainable. Any of you who are going to earn a decent living, you will never see a dime. You will pay 12% of your income into the tax. You will get nothing. And I fully expect I've built my entire investment portfolio around the assumption that I would get nothing. And I expect to get nothing. And anyone over 55 who is in the delusion, if you're a high income earner and you're under the delusion that you're actually going to get paid and you're not currently collecting, that ain't going to happen. It's just not.
So if you can't collect, just start collecting now while there's some money there.
Again, the normal answer would be, right, defer your payments until later because you'll get more. All right. The fact of the matter is, if you're a low income earner, you'll be taken care of. But a high income earner will never see anything. It can't. The numbers don't work. And eventually, we'll all come to that realization. It's just a question of time. And that, along with these other things, will resolve the U.S. fiscal problem. Okay. With that cheery note, let me move on. Okay. So go ahead. Sorry.
Sort of take what this baseline forecast.
Okay. You want me to go back to the baseline? Okay.
No. And I want to see how that, assuming that baseline, the impact to multifamily.
Okay.
So almost everybody on this call is multifamily.
All right. So let's work this as if this is what we think is roughly going to happen, right?
Right.
Roughly speaking. Okay. What does that imply? Probably a slower level of demand and probably a downside risk to your rent, even my rent forecasts, okay, which are kind of, modest in the high supply markets and 3 to 4% in the low supply markets. So you're probably going to see something clipping that as it plays out. Now, remember, the first quarter was great, by the way. We did not see that in the first quarter at all. We will probably see it not in the second quarter because things are pretty good. It's probably going to show up in the third and fourth quarters, would be my guess, okay, in the multifamily impact. Because again, if you look at inflation, take out housing, we were at 2% inflation already. Housing was the long pole in the tent. It was beginning to come down, but it comes down slowly because obviously with high interest rates, what we're seeing in multifamily, anyone who's operating will see higher retention, lower turnover, higher increases on renewals than new business, and a meaningful gap, okay? Which has kind of been floating everybody who's in a high supply market because you're still getting increases or even small increases on renewals, okay? And you can't get it. The only way to get this thing down was to get everything, the non-housing down to 1.5. That was never going to happen with the level of deglobalization going on. Never, no way, not going to happen, not going to happen now, okay? Because the same issue. Now, we track the sort of government statistics on CPI, and we know that it more closely measures in-place rents, okay, it could be as opposed to asking rents, which spiked earlier and came down. This is by design. This is how the government statistic looks at housing. We actually have clients several Federal Reserve banks are our clients, and they're doing it to get access to this information, which comes out of our expert system, which is aggregated and anonymized accounting and property management information, because this is the closest metric to how the government does these owner's equivalent rent and housing matrices. Okay. Raw material prices. The bottom line is the supply chain had kind of chilled out. Okay, as deglobalization was occurring, now it's going to go to another level. And it's going to kind of go on steroids. Construction spending had been increasing rather dramatically as deglobalization and reshoring and reindustrialization was continuing. This will probably go down for a tad, but then go back up. It's inevitable. Okay. Now, when you go to the labor market was kind of beginning to loosen. All right. With the quits rate was still kind of hanging in there. Vacancies were falling, and it's tight. Now, this is probably if you're talking about the labor market, this is probably the pivotal chart that I need to cover with you guys, which is the labor force participation rate among prime age Americans is above COVID levels. The issue is older Americans, which are a greater percentage of the population, their labor force participation rate is lower and is not coming back. This is the structural skilled labor shortage, which ain't going away. So the need to continue to invest in technology, invest in productivity enhancements is not going to go away. It's not changing. This is the core sort of fundamental around labor force and labor costs, okay? Now, if you look at the character of job formation since the interest rates went up, very, very indicative. This is another key issue. Jobs accepting government, healthcare, leisure, and hospitality are down since 2022. Those are the sectors that actually create wealth and have positive spin-off effects. Not that isn't wonderful for those folks to have jobs, but the fact of the matter is those sectors don't create wealth. They extract wealth from the productive sectors of the society. And so this is the real happening. And again, if you look at full-time versus part-time employment has been increasing. So consumer stress has been increasing under the covers. And quite frankly, a lot of that is what drove the result of the election in things that were not fully measured in the sort of headline numbers, because this is a little bit under the cover. Okay. There's also unemployment rates that are vary by, kind of by city. I want to kind of go over that too much. This is an important thing. When I look at the employment cost index, which includes fringes, it tends to lead by about 2 quarters. It tends to lead wages. Okay. So if you look at the quits rate, right? Look at the quits rate, which is down here. And then you look at labor force, the earned employment cost index, it lags by 2 quarters. And so what you're seeing is, in general, wage inflation was coming down. All right. Again, that's why you could get 2% overall inflation, except for housing costs. We expect this to also continue. Okay. If you look at productivity, Productivity is, when you look at headline wage rates minus productivity, you get the true measure of what's called unit labor costs. And that's what the real underlying level of inflation is. So when you get kind of 2-ish% productivity, or even then, and 4% or 3.5%, you get 1.5 to 2% unit labor costs, which is right in the strike zone. Okay. And you look at US labor productivity, it's actually been pretty darn good relative to the rest of the G7. Okay. So the US continues to perform well. Again, not without its problems, but understand that this is what's kind of happening with the trade policy. The U.S. basically gave up its mid-level and lower manufacturing jobs in order to bribe the allies, okay, of Western Europe to give up some of their defense autonomy back in the 50s. The bet in 2000, as the U.S. was trying, it started in the 80s, the U.S. was trying to decouple China from Russia, which was the main enemy in the 80s. And then in 2000, we had Deng Xiaoping and the liberalization of the Communist Party. You had seen in Asia significant movement of authoritarian regimes to a form of democracy. The bet was by bringing China into the sort of U.S.-led global order, that they would eventually basically fall away. Remember, you had the Soviet Union's fall away. The bet was that would happen in China in 25 years. The Chinese Communist Party has been far more successful at retaining power, and that bet didn't pay off. And the people who paid it were Midwestern factory workers. That's the way it goes. It was always part of the plan. It's just the costs have escalated beyond that, which were now tolerable. That's it. It's really not that complex. Okay. There is pressure among lower-end consumers. You can see credit card debt. If I had auto loans, I'd see the same thing. Pressures building at the lower end. This is the reality of inflation, which hit lower-income Americans far worse than upper-income Americans. Okay? So, again, that is the sort of the group. You heard Secretary Bessent say it. 50% of the U.S. population has no assets. That is the Trump constituency, and they are working to reconfigure the economic system to address the needs of that component of the economic system. Okay, let's go to multifamily. Okay, so from a multifamily perspective, all right, we're seeing basically rents kind of flatline, right? 1.2% year over year, month over month, kind of flat. Not bad. I'll show you. I think we had March numbers, which I have actually March was a decent number. Actually, a little bit higher, 1.2% year over year growth. And I think it was like 0.3. But again, 0.3 was pretty good. And then if you go market by market, actually, March was pretty good on a sequential basis in most markets. You even saw a sequential movement positive in Seattle, in the Bay Area, in San Francisco. You saw something happening, and many of the tech hub markets weren't that bad, right? They weren't like getting crushed. If there was declines, they were somewhat minor. Okay, so March actually was also a pretty good month on a sequential basis. And the characterization of that is always at the back end of a cycle, lifestyle, upper end properties underperform because, of course, that's when new supply hits. Okay, so this pattern of where rents grow and how they grow within the cycle, very, very typical. I was a COO of an apartment REIT for a long time, and we saw this same cycle in previous characterization in previous cycles. It's completely normal. Now, this is just an understanding here of this is data coming out of our expert system of you see this is, and this is transacted actual executed rents. You can kind of see the new rent growth spiked and then it has decelerated and it's kind of bouncing around 2-ish%. And the rate of growth of the in-place rent roll has declined. Now, on the right here is actually the sort of actual in-place rent roll. And you can see that loss to lease compress right on top of each other. Again, in some markets, it's flipped and the overall rent roll kind of beginning to flatten out. When you peel the onion on this geographically, this isn't a surprise, right? To the right, great markets, great economies, just a lot of supply needing to get absorbed, right? And then to the left, Midwestern, Northeastern markets with just not a lot of supply and modest rent and, modest job growth. And you're sort of seeing that. Now, will DC be hit? I think yes, eventually. It's got to be. Okay. When you look at Northern Virginia and DC, it's actually performing pretty well at the moment. But then again, nobody's really lost their income. Maybe they lost their job and they're on severance. And so it hasn't really kind of played out. But Northern Virginia and Washington, D.C. are bound to be hit over the next, several months. This is just a kind of a chart of national occupancy, kind of sequentially. We're kind of back to the COVID level.
Jeff, go back one slide for me.
Yes, this right here.
Yeah, this slide. All right. So we got Houston, Dallas, Austin. I don't see San Antonio on this chart, but maybe touch on those three. It looks like Houston's flat, Dallas.
Houston's okay. Dallas is okay. I remember, Houston doesn't have a lot of supply this cycle. Austin's got a ton, and Dallas has a reasonable amount for Dallas. Okay, but Dallas is still growing. Performance isn't great, but it's not bad. Okay, so I'd say that Houston has been sort of ignored this cycle. Not a lot has happened in it. It didn't have a lot of big supply response. It didn't have a big rent growth. Dallas is just a behemoth, right? It's churning out jobs, it's churning out growth, but its rent growth is modest. Again, and we split up the Metroplex into the north part, that kind of northern part, the southern part, and then Fort Worth. Fort Worth and the southern part have not done as well as the northern part, but all the supply is the northern part all the way through and up into Oklahoma. So again, I'd say this is sort of like par for the course, okay? And I don't expect this to meaningfully differ until 2027. Absorption has been pretty good, right? An amazing amount of absorption has occurred. Those are pretty good numbers for such a large number of units that are being delivered. When you kind of peel this back by gateway and tech hub markets, this is on the rent growth, the cumulative rent growth. San Francisco is still kind of in pretty bad shape, but it shows a little bit of sign of life. And these other markets, Chicago, New York, have done actually pretty well. And of course, you're seeing now, right? Miami kind of acts like a core market. You're seeing the supply response come into these markets, and rents on asking rent basis going to start coming down some. Again, when you look at occupancy, pretty much the same kind of deal, right? You had a big pop up, and now to a certain extent they've come in some. The Phoenix the most because of the amount of supply. This isn't rocket science. This is kind of your normal, typical expectation of how I'd expect to see. Chicago and New York have done pretty well in this environment. When we look at the tertiary markets, right, the population of the U.S. has been spreading, okay, and in those places where there hasn't been a lot of supply, rents are growing 3 to 5%. That's not bad for a lot of small places. Now there are some Huntsville, Tucson, Jacksonville, Colorado Springs. I live in Denver, so where there's been a lot of supply added, and guess what? Rents have come down some. Not a big surprise, right? Now, one of the things we have seen, which does indicate that the mortgage rates do matter somewhat, is that 2-bedroom units are performing better than 1-bedrooms. This is a new lease trade-out metric, which is paired lease transactions compared to 2-bedroom versus 1-bedroom. You can kind of see 2-bedrooms have performed in a lot of markets much better than ones. This is on new leases, and this also is true to a large degree on renewals as well. Okay, again, indicating, again, if I look at also retention rates are relatively high than they've been in the past. Turnover rates are relatively low, which is that there is an impact for people not moving into homes because, they can't. Again, at the margin, that's very true. There is a housing shortage. There's different ways in which people sort of view that housing shortage. Is it, a couple million, a lot million? But the bottom line is, let's call it several million homes short. About maybe 1/3 of that is viewed as multifamily, 2/3 are single family, but you're in a several million unit shortage. And part of that is just the amount of production relative to housing starts per 100,000 households is just plain down. That's accumulated over time. There's a cyclical component and then there's a structural component. The cyclical is kind of, cost of money. The structural is the increasing burden of zoning, permitting, design requirements, just making it harder to get things done. Okay? That is the sort of thing that people can change. Communities can change this. They can change this, at least from the structural side. And from the data from the NMHC, about 40% of the cost of adding supply is regulatory related. So it's a meaningful impact which can be addressed. And I've got examples of cities that have done it when they put their mind to it.
Jeff, go back maybe 2 slides.
Okay.
To the
shortage?
The shortage. What are you hearing from single family builders? Because I feel like on the multi side,
Yeah.
there's really nothing being started on the multi side right now in terms of starts,
Well,
unless
there's some,
like
but
some, but
it's down.
yeah.
Well, what's happening with single family builders, I am close to the folks in the street. They're not buying land. They're buying back stock,
Okay.
and that's what they're doing. And they are, for the units that they do want to move, they're buying down the mortgages to
Okay.
5%. So they're buying down the mortgage at that to 5% to get people in the home. Basically, skinning up their margin a little bit in order to move the product, but they are scaling back production. They are not accelerating production.
Okay.
So they're basically taking a higher margin. Some of it is to buy down the mortgage. The rest of it is to buy back stock.
So on the single
So
family side, are they on the same timeline as the multi stuff, or are they on a different timeline in
um,
terms of
in
like
terms
if
of
you see
cycle time,
26, 27, we see multi come back in terms of rent growth just because, it
I,
takes 3 years to.
remember, you haven't seen a big break in single family home prices. Now you are
Right.
beginning to see a run up in inventory in Texas and Florida,
Okay.
which is the precursor for price reductions. Okay. And there are modest price reductions taken. By the way, I follow a thing called ReVenture, which has they basically repurpose a lot of the single family data. So when I'm looking for single family data just to sort of line myself out versus multifamily, for $39 a month, I go sign up for ReVenture. And it's just a good way of tracking inventory levels of single family just to make sure I'm not missing something. Because there is an interaction effect between the asset types. Okay.
Right.
It's not perfect, but it's related. And so I can definitely see that increase in inventory. And guess where you're not seeing an increase in inventory? The Northeast and the Midwest.
Okay.
So the fundamentals kind of tend to carry, okay, across. Again, they're related. They're not exactly, the same. And the SFR BTR segment, which is small, I love. And there's also obviously the SFRs, the scattered site world as well. Okay, so I'm going to go back to here. We are seeing this is our starts data, which is verified. Usually works with a 1.5 quarter lag. So we're at about 400,000 units total started in 2024. This is when I restated I just got the March's restated numbers. 2023 didn't get restated. 2024 went up about 20,000 units. And we actually track all of these asset types. So we'll do some crosswalking between us and some of our competitors. They don't include other of these housing types. That's why our number tends to be bigger, but I think more accurate. Okay, particularly fully affordable. They don't track. But again, the trend line is clearly down. Okay, and therefore the expectation of deliveries is clearly down. Now, 2027, I feel very comfortable is going to land around this number. Okay, now what happens in 28 through 30 kind of depends upon the ability to get stuff financed. Everything's hung up. We have in our pipeline 5.5 million units of multifamily in the pipeline, 1.1 million under construction, which will get delivered, 1.1 million of planned, which is they have an approved plan, but they haven't poured a foundation. Maybe they got a permit. And then 3.3 million of projects that have been identified that they would like to build but can't get financed, don't have an approved plan. So all of the units necessary to resolve the housing shortage have been identified but can't get built. And now it's a question of, will financial conditions be in such a place that those could actually move forward? That we don't know enough yet. Okay, so the question is, does this level off around this number, or does this move back, up another 50, 100,000 units? That's kind of an open question.
And Jeff, what we're seeing is obviously rates are higher on the bank side still because federal funds hasn't moved much.
And it's not like building materials are any cheaper. Lumber maybe
building materials are higher. And
building materials are higher. Money is not cheaper. So it's hard to see how this thing suddenly changes unless something meaningfully changes, right? So that's
27 might look like 28 if a lot of this stuff can't.
Exactly. If nothing really changes, and affordable, fully affordable, which is government subsidized, is a growing percentage of the total because it's subsidized versus market rate. The drop off in market rate has been much steeper than the overall. Okay, so this is the starts on a graphical basis. You can see that collapse in market rate starts. It's come down in a meaningful. This is all luxury. So market rate, think of that as luxury housing, right? Where the reduction in the other sides has been less. Yes, it's come down, but less come down. Okay, so that's kind of what we're seeing, and this also then looks at the sort of what we think what the deliveries are by product type. Okay, so there's 60 or 70,000 fully affordable units that will be continued to be delivered through this cycle. Now, this was our attempt to take a look at by city, when do we think peak deliveries actually are, right? So there's still most markets, right, have actually hit the peak and will now be delivering fewer units, okay, than they had in the past. There's still a few markets that still have more to get through before they hit the peak. There's still going to be units delivered, but you're talking about peak deliveries. So Austin's still going to slug it out.
Do you know where Dallas is on this guy?
Dallas really is not in a high supply market view. We view it as 2 to 3% stock. It's kind of normalized. So Dallas doesn't make it to. Dallas has a lot of units delivering, but as a percent of the stock, it's actually quite modest. And I think I've got that on the next slide here. So if you take a look at this is Dallas. This is the Metroplex. Over the next five years, it delivers 2.5% of stock. A lot of units, but the Dallas Metroplex is a massive metropolitan area, and so it's just not that big. My number is anything over 5 is the red flag. Okay, so over a 5-year period, even Charlotte's 4.7, even Austin's 4.2. It's just that it's front end loaded, and then it drops a lot. Okay, again, what I'm saying is like, if you look over a longer period of time, even with a fairly aggressive assumption of deliveries in 28 through 30, none of these markets are going to be oversupplied. So that's why I believe in investing for the long term in good markets that are business friendly and are open to growth, and where there's a public policy consensus around growth. So anyway, that's the supply view, and our rent forecast pretty much is, hey, now it could be worse in 2025. We could be at maybe 1 versus 1.5, or it's 0.8, which would be more like 2024. And then we kind of come out of this nationally. Okay. The question is, will you see more of a bigger bounce in 27 in a lot of the markets? You probably will. Okay. Again, my guys who are the modelers are fairly conservative people. So, I do what I can, but I have to let them do their thing. And so that's what I would kind of tell you is, and if you look at this, right, these are kind of not unusual-ish numbers. Again, this was assuming a first quarter 2024 base case assumptions. So again, the reality is it could be a little bit worse than this number, but these aren't bad. Okay. Again, some of these markets are going to struggle as they have to absorb supply. Okay. Now, I won't go over this, but quickly here, but we are able to have aggregated and anonymized expense data. And so we're coming off of a deceleration in expense growth. So expenses are still growing. They're growing at a slower rate than they had been previously. And if I went back to various years, 2022 was also kind of a big, like a 10% year. So we did see, again, you guys see this in your own pro formas, but we are seeing a deceleration in growth. It does vary significantly by city. Okay. So within that, you have some cities with rather significant expense growth and some others that have not. And then also there's a difference in margins between the conventional and affordable, largely driven by rent levels in the different cities that we track. And this is just kind of from the expert system, kind of a breakdown in the expense load, and then the growth of that insurance still going up, but on the conventional side beginning to mitigate. And this is the importance of taxes and why there are plays of using partial affordability programs to create tax benefits that honestly could make a lot of sense, and from the government might not make a lot of sense, but preserve affordability and save you on your taxes. And then we look at this kind of growth rate in insurance costs, you can kind of see that was a 33% hit nationally, right? So some other places got whacked really hard. 10% nationally can still be painful. But you look at the increase in rents, in insurance expenses, this is a pretty hard market since COVID hit. 13, 17, 13, 17, 33. That's a hit. I mean, so you gone from cost per unit.
See that. Yeah, Jeff, I didn't see that in one pro forma.
This one?
Yeah. No, just with this insurance is just, yeah. from 300 a door to 7 or 800.
This is nationally, right?
Yeah,
And obviously you're going to have differences in Texas and Florida, much, much worse than you're going to have in other places. But again, this is the national side of things. All right. So the amount of time, we don't have a lot of time. I want to cover very, very briefly some things about what I would call work from home. And the fact of the matter is, for despite anyone else talking their book, hybrid work is kind of the new norm. Now, this really depends upon the kind of company, the industry, and the function. Okay. Remember, we're in a general skilled labor shortage world. Okay. In that environment, companies want to retain trained workers unless they overhired. Guess the people who were most vociferous in the tech side were people, it was a back-ended riff. Okay. Done it a million times. It was just another way to cut headcount when you overhired. Take the tech, because the tech industry, the tech companies that are right-sized, they ain't doing return to office. It ain't happening. Okay. Now, the finance industry, the legal industry, deal teams, early stage tech, absolutely makes sense to have people together all the time. Totally.
Yep.
That's about a third of the workforce. About 20% are basically full-time, highly skilled, living anywhere. And about 50-ish, 45, 50% are people who are hybrid. And if they're hybrid, it's 2.5 days. That's kind of the way it goes. This data comes from the Flex Index, a great little company, been collecting this data for quite a while, been very stable. Okay. This obviously varies by industry. Okay. That makes sense. And obviously by whether you have to be in person, right? Hospitality is in person. And because the people at the front line are in person, it's very hard for the headquarters staff not to be in an office. Okay. It just isn't fair. This actually also happens with real estate, right? If you have a lot of people on site, it's very hard for the team to say, yeah, I'm going to work from home. You have to be on site, but not me. Very hard to work. Technology, very different other services. Now, because of the industry makeup of a city, of a metro area, then you get a makeup of how much is flexible. And also a spreading of the population, which is why the suburbs have tended to do well. Not that the urban areas aren't going to do well to a certain extent, but not the way they otherwise would have. Okay. And that's real. So the suburbs are definitely outperforming urban centers, even though urban centers aren't dead. They're not dead. They're very attractive to younger Americans, to people just out of college who want to be in a live, work, kind of play environment. But it's not the way it was. Okay. State to state migration is kind of going back to pre-COVID norms. And this is the cumulative change since COVID. This shouldn't surprise you a ton, right? The Southeast, Texas, the Mountain West, right? Now, and this is just the number of people, but even last year, if you kind of carry that forward, which is kind of tail end of COVID, entering normalization, the same trends are occurring, but at a slower pace. Carolina is still growing, Florida, Texas, the Mountain West, still growing, okay? What is some of the common themes? The more left-ish you are, you tend to grow a bit slower. Okay, with some exceptions, but that's pretty much the story. We also track population growth, and we do our own population forecasting. Again, this kind of lines out with what you would expect to kind of see in terms of growth. The other part of that is home sales, and obviously, home formation being lower. This means just not as many people are moving. We had the lock-in effect. Again, and also you haven't yet had a lot of distress inventory in the single family hit. This matters a lot for self-storage. Okay. And then this is just home sales a percent, Idaho and Utah have been higher, and then the year-over-year change. So going to population, this is just looking at our current U.S. population, even adjusting for, if we adjust for the number of illegal immigrants, about 10, 12 million more people, it changes a little bit in the front end of the year, but the slope is essentially the same, which is 2040, we kind of top out in terms of renter demographics. Okay. And what that means is you got 15 years probably of growth in the total number of renters. After 2040, it's about where you are. Are you in business-friendly locations that continue to have domestic migration and continue to grow? All right. So places like Dallas, places like the Mountain West, are the ones that are continue to be able to handle new demand. Right. And so that's again, kind of how we think about it. Now, in reindustrialization, this was even before this most recent actions by the administration. The Midwest has been performing quite well all across the board. It's affordable. There's been a little bit of development, and there's been job growth. So these Midwestern markets, which are kind of I'll view as largely flyover country, have been having their moment for a couple years already. Okay, you have the combination of what Biden did and is still where money's still flowing through, plus what Trump is doing as well. These are going to be smaller, southern places where there's lots of land to build around, places out in the outskirts of Dallas, and I think that southeast part where they're building a big chip plant, Arizona outside of Phoenix. And so these are some smaller markets where there's been significant investments already, and there will be more. And what's been the supply response so far? And then sort of where you play with that, right? I think the Midwest and this more rural Southeast will continue to benefit from this reshoring, reindustrialization trend. I also think from Houston all the way through Louisiana, the petrochemical industry is still building out. The U.S. is blessed. We have the cheapest energy, we have water, we have food, and the last piece was building out the industrial plant. And we have technology, we have educated workers. We've got a lot of big positives as an economy. All right, so I think I'm kind of out of time. There's some other stuff I could cover. James, you've got the slides. You can share it with everybody here, but I don't think I can do any more.
Yeah,
I think we are kind of out of time, but I think we covered the areas, I hope, that were most critical to what was on people's minds. And I think the other sections we just didn't get to. But again, happy to share the slides and happy to answer any people's questions if they have them.
I have a couple questions.
Fire away, man.
All right. I'll pull it up. Do you want to stop sharing your screen?
Yeah, I'll stop my sharing screen. You can kind of go from there.
Yeah, let me pull this up and let me see if I can do it.
Okay.
While we wait for people to sort of put in their questions here.
Yeah.
Okay. So you see a lot. So that's why I wanted to, and we'll do a rapid fire because I know you got to jump.
Yeah.
But maybe a couple minutes on each one of these questions. So the biggest operators right now,
cost reduction.
So what does that mean? On the property level or the headquarters level?
Everything related to what can I adopt in terms of technology that drives down my site level operating cost and the support costs that are required to support those sites. Okay. Centralization of services. So there's centralization of a number of the functions and then scaling that down. Automation, chatbots, using AI embedded in a lot of the technology tools. It is cost reduction mode heavy. Okay. Now, right now, it's kind of hard to make value add deals kind of work, except if you're in the Midwest. All right. So that's not happening. It's hard to get big rent growth when you're just trying to absorb that new supply and hang on for dear life. So they are focused on customer experience, customer retention, and driving labor cost out.
Perfect.
What's next?
What items do you see sort of on the A side that might trickle into B and C?
We are seeing some kind of, I'll call it home tech type stuff.
Okay.
The digital lock world, the cameras, the secure, those kinds of things that make life easier for people, help them control their energy costs, digital thermostats. So I see a lot of that. Again, bandwidth is de rigueur. There is an emerging whole thing about how do you leverage your payment? One of the things we're doing as a company is basically trying to get a bigger share of wallet for our clients. I'm talking now from a Yardi system standpoint, not Yardi Matrix.
Right.
We're basically helping people with the move-in process and trying to gain share of wallet. So there is a big share of wallet that most owner operators can't grab a hand on. How do you get a piece of the utilities? How do you get a piece of move-ins? How do you get a piece of all of the ancillary revenues around the rent and around the living experience? And how do you also get people moved in a smoother experience that reduces friction? A lot of movement there. Yardi just rolled out a massive new suite of services that basically create earnings opportunities for the owner operator, manager, as well as obviously operations for us, and take it out of other parts of the customer's wallet. So the customer's already spending the money. How do you get a bigger share of wallet?
Yeah, how do you just it's a one-stop shop instead of going five different places to move in?
Again, easier for the customer, and you actually can share some of the benefits of lower cost or reduced friction, which is saving them time, plus a bigger share of wallet. I see that clearly happening over time.
All right. Where is there more opportunity right now? Class A, B, or C?
Let's split this up, right? So one, if you're looking to basically get in front of busted deals, then it's going to be anything in the high supply markets that were bought late in the cycle with variable rate debt with eroding fundamentals. And so one of the things we've done, we actually are piloting and testing an AI assistant called Virtuoso that actually goes and runs against our back end and basically just delivers you investment candidates. So that's one piece is like, I'll call it busted deals, but again, you got to get in front of those deals and then wait for something to drop, and you can't tell exactly when it's going to drop. Okay, I think B is always generally the place most insulated. I would probably say Class B is probably the best place to go in, I'll call it secondary/tertiary markets. When I say primary markets, I'm thinking Chicago, New York, San Francisco, LA. Secondary markets being the top 30 to 40 major technology hubs. Okay, call that Atlanta, Orlando, Tampa, Dallas, right? And then tertiary are going to be smaller cities, okay, below that. I think the long-term bet is tertiary cities Class B. There's not a lot of competition among institutions. They haven't yet found them. We're on the hunt to find the next tier of emerging tech markets. With the spreading of the population, with affordability, there is a knowledge economy going to happen. And if there's also manufacturing or production, it'll all be Class B anyway, right? So again, those places will also benefit. So you're looking for that. What is the next set of rising cities for which you will be able to eventually sell out to an institution that's suddenly discovered? For those of you who don't remember, okay, 10, 15 years ago, Austin was a tertiary city. Denver was a tertiary city. And institutional investors would never invest in these places, ever. Okay. Columbus, Ohio was a tertiary city. Okay. Nashville was a tertiary city. But the cities changed. And with them, they opened up a broader investor pool who actually were willing to pay a lower cap rate for it. And that's where we tend to look, again, depending upon your investment strategy. Because one thing I love about real estate is there's a million ways to make money. There's very different investment strategies aligned with your capital, both in terms of return expectations, risk profiles, and how long you want to allow your capital to sit. And so it's really a question of tying what is your capital need and then tying your investment strategy to that capital. And when there's a good alignment, it works. Your biggest problem is when there's a mismatch, when your capital expects one thing and you're investing with a different kind of approach. Sorry, I hope that was a better answer.
That is a fabulous answer. I've never heard anyone articulate it that way. The Austin example is so prime because when I graduated, not one person graduated and wanted to live in Austin. But now every single person, changed. Yeah, it's completely changed.
It's changed. So what you're looking for is, can you find cities that have the components of how they will change their nature? Okay, and that's something that we look at, quite a bit.
Do you want to give us one or two that you're looking at? Not that you have to bet on it right now, but
I'd be looking at actually, if you come to our webinar in the middle of May, I will give you a list of about a dozen. But I don't want to. I don't want to share my thunder. Don't want to give it away. But we've been doing some work in this area.
Okay, no, that's perfect. So I think you touched on this a little bit, but if GDP is going to be lower because of tariffs,
right? So what should you be doing? Well, you better start looking on ways to cut costs. Like go back and do that again. If you did it, do it again. Okay.
One more time.
Secondly, it is more likely that more properties will finally shake loose in terms of stress sales. A lot of it is happening quietly. So you need to have information that allows you to get to, but there's not going to be a lot of public pronouncement when people want to air their dirty laundry. Issues are getting resolved. They're getting resolved quietly. Okay. The bank doesn't want to, or the lender doesn't want to have to sort of air their dirty laundry. The GP doesn't want to, the LP doesn't want, they want to resolve their issues. They don't want too many people to know about it. So I do think there is a greater likelihood that more of those kind of like precariously financed deals are going to shake loose. I think that's probably one of the, again, I've been saying this for like 3 years, like, yeah, it's going to happen. It's going to happen. And it hasn't happened, right? So I don't think it'll suddenly be a flood, but I think it'll be a bigger trickle. Okay. But again, the lender is looking at this largely saying, I don't care if the equity gets wiped out, but I see there's long-term shortages of housing. I'm not going to take a haircut.
Right.
So that's the issue is saying, and then how do you basically give the equity a hope certificate, a back-ended hope, and facilitate that happening? Remember, the best capitalized owners will do a capital call. They'll pull money from another investment to not realize that loss. So it's going to be largely thinly capitalized newer entrants who just got over their skis.
All right. This is the last one, I think.
Yes.
How does this downturn so far compare to 2008?
It's not nearly as bad, nor will it be nearly as bad. Okay.
Sure.
And the reason is it is not a result of excess leverage. You do not have where is the excess leverage? The excess leverage is in the government, not with private actors. So what was so unique about 2008? Actually, it wasn't unique. Read Ray Dalio. Every 80 to 100 years, you have a debt blowout. 08 was the debt blowout. We've been living in 08 think about 08 was 1930. We've been living through that. Okay. We've managed to avoid a world war so far. But I can tell you, if you look at 08 as an analogous to 1929, 1930 and run through it, you can see the traps happening, COVID being the exception. But all of it's basically been played out the same way. Okay. Actually, it's been managed much better. Is not nearly as bad as 08. Not nearly. Not even close. This was bumpy. There needs to be a restructuring. It's not debt driven. Government is the issue with the debt, not the private sector.
So if you had to put us in a year comparing that recession, even though this is a little shallower.
It's shallow. I mean, I don't even think we're going to be in a recession. There isn't a financial crisis, right? There's not a financial crisis. What happened in the market had all the hallmarks of a correction. Sharp, fast, and bounce back fast. Emotionally driven, not driven by data. Okay. This is a classic correction that we're in inside of a bull market. This is bear markets grind their way to a top. This ain't it. We're still in a bull market on the equity side.
All right.
All right. So we're not even there because we're actually, this is a correction.
All right. Well, Jeff,
there you go.
Thank you so much for coming on. I appreciate you. Yeah, send the slides when you have a moment, and we'll send.
I sent
you.
Okay,
all right.
You have the slides. Feel free to distribute them. Hope you guys have a wonderful evening. I got to run. It's been a lot of fun, and I hope buckle up, have some fun, look for opportunities as they present themselves. There again, where turbulence and volatility exists, so does opportunity. Take care, everybody. Bye-bye now.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.